There's not a lot of good balance sheets on these markets. That's why Buffett's hundreds of billions in cash, despite the frothy tops now, which you just mentioned. Heinrich Sieberg, he's just as bearish as me, but he called for higher highs before this thing tanks, and he's been correct. So you can be temporarily bullish, or you can be risk on in a very risky topping market. That's up to your personality if you're a speculator. Sophisticated speculators would be, I think, more protected than just passive ETF investors who are listening to their financial advisors or RIA industrial complex, which is pure consensus think. Because in a bull market, everyone looks brilliant. In a Fed supported market, everyone looks brilliant. And when something goes wrong, they'll blame it on exogenous events or black swans, and they'll take no responsibility. And I think there's a large class of people who can't afford another 40, 50% dip, especially if you're older. And there's a society that relies on a 401k. There's a middle class that relies on a 401k that cannot afford that, because if we have another major dip, the only way to save that would be to have QE to the moon to effectively monetize the equity markets. You could even have direct investments in equities. Yellen talked about that years ago. Or you could just do super QE, and that would create another headline bull, but that will be at the expense of the dollar you measure your portfolio in. And again, that dollar on a relative and on an absolute basis is compounding losses year to year. If we're losing 10% this year and 6% the year before and 5 and 9 before that, in just the last 4 or 5 years, you're losing 25%. So your dollar buys 25 cents less. On a compounding level, that is extremely painful. Buffett talked about that. Don't underestimate compounding returns. Don't ever estimate compounding losses through the invisible tax of inflation and the debasement of your currency. That is absolutely fatal. It ignores, even if the markets are up 7%, if the actual inflation is 9 or 10%, because we know the CPI is bogus. It's been adjusted 22 times since 1980. It's a fiction. We know without the BLS telling us that $10 or $100 doesn't buy what it did 10 years ago. It just doesn't. So if you're making $10 or $100 more, you're still running uphill in roller skates. I think that's the big trap. If you're getting 20% this year, or you got 8%, or Jeremy Siegel's annualized 8%, you're losing all of that to inflation anyway. And again, that's just empirical. That's not just trying to be negative, unless you trust the BLS's measure of inflation, which I never did and never will. So yeah, high frequency trading, ETFs, very, very dangerous combination with a very dovish Fed and a very, I think, comfortably numb retail investment class that thinks the next 5 to 10 years are going to be like the last 5 to 10 years. And the only way that the markets will stay at these levels for the next 5 to 10 years would be at the absolute expense of the dollar you measure your wealth in, or the euro or the franc or whatever. It's an absolute charade, and it's not sustainable, because eventually the bond market is not going to be saved by a central bank. The central banks think they can control bond yields. The central banks think they can control debt markets. And I've said many times, that's like a yachtsman, even a very talented sailor. That's like saying they can control the ocean. And my father-in-law, my mother-in-law sailed around the world twice on a boat he built with his own hands. And he saw many friends disappear in the Indian Ocean or across South Africa or coming up from Morocco. To think that you can control the oceans is hubris at its highest. But the hubris at its highest now is to think you can control the weather or you can control bond market. The Fed for many years has said they can do that, and the ECB, etc., but they can't. Eventually, bonds fall of their own accord, yields spike. You can try yield curve controls, you can try QE, you can try to liquefy that market. But eventually the bond market will get the last laugh, and that will probably be the needle which pops this Fed air balloon and sends this credit cycle and those ETFs and those high frequency trading algorithms into an uh-oh moment. And that's where you'll see the escalator down as opposed to the steps up. And markets are mostly bullish. They're mostly positive. But when they're negative, they're brutal. And what's happening now is if we have another '08 moment or 2001 NASDAQ moment, we don't have the credibility anymore with our currency or our bond market to print 4 trillion. And so there's going to have to be some pretty tough scenarios. The bond market is everything. It is the stock market. And we could talk about those scenarios are going to be, but there won't be another '08 dip with an '09 rip. And so this temporary prosperity, this good times, I can tell you what I think the signals are. I don't have the timing. That's a mug's game, but it's not sustainable. And, enter at your own risk at chasing these tops. And again, I've chased tops in 2020. I've chased them in 2024, even though they were overvalued. But I'm much more like Buffett now. Enough is enough. I don't know if it ends in a week, a month, or 6 months, but I don't care. And frankly, I'd rather preserve the wealth that I have right now rather than chase some more. And I recognize there are many who don't have that problem or that high class problem, and they're trying to beat inflation or pay the mortgage or get through the year by speculating. I respect that. I think they just need to be very, very aware of the risks. And even if they do succeed, quote unquote, an 8 or 10% annualized return, they've got to understand how inflation is actually just taking a lot of that away from them. And so what else can they do to prepare? And that's why I went from stocks and risk assets into precious metals, not because I thought it was a chance to get rich quick, quick, I thought it was a chance to avoid getting slaughtered. And I'm very proud of that. I mean, gold is up 25% this year. It's the best performing asset of 2025. It's outperformed the S&P for the last 20 years on a total return basis. So even on a purely speculation mindset, gold has done better for me than the S&P if I bought a passive ETF index. But again, I realize Nvidia or Bitcoin in certain periods can rip past anything else. But there's all different ways to look at your statistical windows or look at your asset classes. I'm not against speculation at all. But I think at this particular time, and I've said that before, there are times where the risk is obvious, but I'm risk off right now because I don't think this is sustainable. It wasn't sustainable in 2020 when I went long. It wasn't sustainable in 2024, but there was a window there. When the Fed is printing money unlimited, it's risk on. When the Fed is bringing rates down, it's risk on because the markets are no longer driven by supply and demand and natural forces or constructive destruction where bad companies fall out of that ETF bag. The markets are driven by liquidity from a central bank or the hope of liquidity from a central bank if anything goes wrong. That is not capitalism. That is not natural price discovery. And that is frankly not the stock market of Benjamin Graham or Warren Buffett in the 70s. It's just not. So we're in a very desperate time. It looks good right now because of a rising S&P, but that's lipstick on a pig. It's hiding trillions of cracks. Global GDP went from 30 trillion in the 90s to 300 trillion today. And in 1971, when we got off the gold standard, again, these are boring numbers, but U.S. debt, public debt, government debt was 246 billion in 1971. Now we're looking at 37 trillion. That's extraordinary in a 50-year period. And our debt to GDP in the 70s was 38%. Now it's at World War II levels of 125%. And again, I'll pause for a second. Just trying to think of those as just me showing off what numbers I can memorize. Think about what that means when you go from 240 billion to 37 trillion. You know, a billion seconds ago was 1997. A trillion seconds ago was 30,000 BC. Just to try and conceptualize the difference between a trillion and a billion. So when you go from 240 some billion in public debt to 37 trillion in a 50-year period, it becomes inconceivable. Not only is it inconceivable, it is mathematically unsustainable. So to answer your question, the debt market and the rise of the cracks in this broken system is going to be, in my opinion, what breaks the stock market. And we are clearly seeing that now. You know, my colleague said in 2016 that U.S. public debt would be 40 trillion by 2025. And he looked like a total kook. They thought he was crazy. But that's exactly where we are because our debt doubles every 8 years. So the bond market is the thing. And a credit collapse and sovereign bonds like the U.S. 10-year, the risk-free return, which again is return-free risk when you measure against actual inflation. When the debt keeps getting bigger and bigger, our deficits go from every 6 months up $1 trillion. Our public debt gets higher and higher. Our entitlements, our military spending, our interest expenses. It comes to a point where that pressure cooker pops. We've seen signs of that in the de-dollarization and the rise of the BRICS, in the COMEX outflows, in the BIS giving gold a tier 1 status alongside the 10-year. We've seen that in the petrodollar moves outside of the US dollar. But that's all happening because no one trusts the world reserve currency today like they did 10 years ago. And no one trusts the 10-year IOU from Uncle Sam like they did 10 years ago. Why? Because we're in too much debt and because we weaponized that world reserve currency in 2022. Again, whatever you think of that, it's no longer trusted. What central banks have been doing since we weaponized the dollars is mathematical. They've tripled their gold pie. Every year since then, central banks have bought over 1,000 tons a year. Individual central banks went up from 118 tons to an average of 290 tons. It basically tripled. Why? They don't trust the world reserve currency as a weaponized currency. They don't trust the 10-year IOU because it's weaponized, and they don't like it because they know the government cannot sustain the debt. So there's a move away from that IOU. If there is a move away from our debt and we are a debt-based society, who's going to pay that debt if they're not going to buy our IOUs? Net, central banks have been net dumping IOUs since 2014. China's been de-dollarizing since 2013. So these are not just numbers, these are signs of trends. And the trends are getting more and more accelerated. As Hemingway said, poverty starts slowly, then all at once. We are hitting that all at once phase objectively. There is a move away from U.S. treasuries into physical gold to net settle trades in the BRICS, to buy oil, to settle energy trades, and even as a world reserve asset. So we're not even talking about gold anymore as a hedge or an allocation or even insurance for dying fiat money. What we are seeing in the last couple of years is gold is replacing the US dollar. Nassim Taleb just said this out loud the other day in an interview with Bloomberg. It's constructively replacing the 10-year US Treasury as a restricted reserve asset, as real money. The kooky conversations that gold bugs have been having for years about credit or currency versus money or credit versus real money that was all laughed at is actually happening in real time. From the IMF to the BIS to the central banks of the world. And the outflows we saw from the COMEX into the COMEX from London in the UK, 2,000 tons to try and cover their ratios of levered paper. Why? Because the COMEX needed more physical gold to meet delivery of countries and counterparties who now want that gold. They don't want to lever it. They don't want to speculate on futures. They want the real thing. Why? Again, because there is a slow but steady and obvious empirical shift away from fiat money in general, in the US dollar in particular, sovereign bonds in general, but most importantly, that sacred 10-year US Treasury. You can't underestimate. That is the only other tier one asset of the BIS. They've just put gold alongside it. That was unthinkable 5 or 10 years ago. And even the IMF, when they talk about central bank digital currency and all the awful that's coming, and it is coming, and the DLT, the blockchain technology is going to bring in central bank digital currency. All the problems aside, even that, they said in their own graph in 2020, is going to be anchored in physical gold. Physical gold is the new direction. It's not even just an argument about currency risk or outperforming the S&P or whether it's a pet rock or an analog has-been versus a Bitcoin superstar. All of that aside, just look at what the world is doing, not what they're saying. Look what they're doing.